The FOMC minutes boosted hawkish Fed expectations yesterday, and the US jobs data due in the next few hours could pour further fuel on the fire. So welcome, this is Swissquote's Daily Market Talk. So the minutes from the Fed's latest monetary policy meeting were more hawkish than expected. In fact, the FOMC minutes revealed yesterday that some officials preferred another 25 basis point hike right away instead of a pause at the latest FOMC meeting. Almost all of the Fed officials said that additional hiking would likely be appropriate, and the forecasts show that they also expect some mild recession moving forward. So the latest FOMC minutes just came to confirm how serious the Federal Reserve is in further tightening its monetary policy and the monetary conditions in the US, and that obviously boosted the Federal Reserve rate hike expectations yesterday. The US 2-year yield came very close to the 5% psychological mark. The US stocks fell, but very slightly actually, because the S&P 500 closed yesterday's session just 0.20% lower, while the Nasdaq 100 index gave back only 0.3%. The US dollar gained, however, and the euro dollar slipped below its 50-day moving average as the Eurozone services PMI fell short of market expectations. Now, the June numbers still hinted at some expansion in the Eurozone services, but the composite PMI slipped into the contraction zone, and that's for the very first time since January this year, hinting that activity in the Eurozone is slowing, and it's slowing as a result of the tightening monetary conditions in the Eurozone as a result of rate hikes in the Eurozone. Now, on the inflation front, the producer prices fell 1.5% year-on-year in May. So that was the first ever deflation that we saw since February 2021. That was good news. And the soft data was accompanied by some comments from the European Central Bank officials. Joachim Nagel, for example, said that the European Central Bank must raise interest rates again, but it's not clear how far they will go. While Italian Governor Visco actually criticized his colleagues at the ECB, who believe that it is okay not to worry about raising the borrowing costs just too far. He instead said that it is an asymmetric attitude towards risks, and even more so as inflation expectations in the Eurozone now keep falling further down. The expectation for the 12-month inflation in the Eurozone fell to 3.9% in May. So it's still twice the European Central Bank's 2% monetary policy target, but it's coming down slowly and steadily, and the trajectory is certainly more important than the number itself at this point of the game. So further opinion divergence at the heart of the ECB will certainly show up as we move forward, but I still believe that the European Central Bank will still continue hiking the interest rates moving forward, because they will simply be just too afraid, too scared to stop hiking too early. And as economic picture in the Eurozone worsens, and as the credit conditions become tighter, as the cheap loans dry up, and as the post-pandemic positivity or impact on the peripheral countries fade away, we will likely see the yield spread between the Eurozone's core and the peripheral countries widen. And that widening could have finally a negative impact on the single currency's valuation, on the single currency's positive trajectory against the US dollar. But today, it's not up to euro to determine the short-term trajectory, but the US dollar will likely determine the overall direction in the FX markets, because all eyes will be obviously on the US jobs data for the next few hours. Now, due today, the ADP report in the US is expected to reveal that the US economy may have added around 228,000 new private jobs in the month of June in the US, while the JOLTS job openings data is expected to have slipped below the 10 million job openings mark in May. Now, the reason why this job openings data is so important is because it shows how tight the US jobs market is by comparing the number of open jobs to the number of unemployed people looking for jobs. And in April, this ratio was around 1.8, simply meaning that there were around 2 jobs for every person looking for a job out there in the US. And that's more than any time any time since the government began collecting data around 2000. Now, of course, this doesn't make full sense for two reasons. I mean, this data is not perfect because first, well, not every job is for everyone. And second, it actually assumes that employed people are not looking for a new job. But hey, you know what? No one is perfect. Nothing is perfect. And the Fed likes the data. So the lower this number, the looser the jobs market, and the looser the US jobs market, the happier the Federal Reserve, and the happier the Federal Reserve, well, the better the investor appetite due to dovish expectations. So fingers are crossed for a loser jobs market data today and a reasonably soft ADP data as well. Because if not, the Federal Reserve expectations will get even more hawkish from where they are right now, and that will likely dampen the mood in all risk asset markets today. Elsewhere, while US crude cleared the all-important 50-day moving average level yesterday to the upside and also took out the April to now descending trend for price tops, the barrel of US crude actually trades a touch below the $72 per barrel level this morning at the time I'm talking here. Now, the next important resistance here is seen near the $73.50 per barrel level, where stands the 100-day moving average. Now, we all know that there is this big fight going on between OPEC, who is obviously ready to do anything to push these oil prices above the $80 per barrel level, and the oil bears, who aggressively fight OPEC back and, well, sell any price peak that follows an OPEC-led rally or OPEC-led comments. But the persistent production cuts from OPEC will at some point become a fundamental problem, unfortunately, and the longer the oil bears fight OPEC and the more OPEC cuts production as a result of it, well, the more severe the impact on global oil glut and the higher the risk of a severe or a big or a decent jump in oil prices. So we all hope that it doesn't happen, given that another rally that we might see in energy prices would again and again interfere with the central bank's fight against inflation, and that would obviously get them to further tighten their monetary policies and hike their interest rates as a result of it, and that would obviously apply a further pressure on the global economy and on asset prices. So we hope that doesn't happen. But one thing that's kind of soothing for investors is that these energy prices can obviously not rally infinitely, especially when the entire world is so sensitive to inflation, because recession worries will rapidly come back on the table and wane the energy rally and settle the prices at reasonable levels. So even with the most optimistic scenario for oil prices, I think that there is little chance that we see these oil prices spike above the $90 per barrel level. Maybe, but just maybe, we could get to the $80 per barrel level. That will make the Saudis happy though. And in the sense, I still believe that it's kind of interesting to have exposure, some positive exposure to energy stocks, which are today in a good position to benefit from one, any energy price that inflation worries that we might see in the next few months. And if not, well, from a rotation to value stocks in the second half of this year after the AI rally that we saw earlier this year. And speaking of technology, well, I like Meta these days with the news of their new platform Threads that will come eventually as a competition to Twitter, which started really and seriously getting on its users' nerves by limiting the number of tweets that they can see and their access to TweetDeck if they don't pay. I mean, who does that, right? That's the only social media platform that blocks access to people who don't pay. Whereas, well, you can just think of it like this. People are already making the platform by their own contribution. Soon, Twitter will ask people to pay to tweet. I mean, that's really weird, and I gradually don't like Twitter since Elon Musk took its ownership, to be perfectly honest with you, and I think that there is now a good opening for Meta, strategically speaking, to amass all the angry users to its own loving and free platform. Now, Meta shares gained 3% at yesterday's trading session, despite a morose overall sentiment elsewhere, and the shares now flirt with the $300 level, so I'm not the only one seeing opportunity in Meta these days. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful messages. I hope this episode of Market Talk has also been helpful and insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. And follow us on Instagram, on Twitter, and on LinkedIn for regular market updates. And subscribe, of course, to our YouTube channel for daily market comments. I will meet you again tomorrow, and until then, good day trading.